In this episode, we share 5 strategies for shopping for home loans that I happen to hate. Let's get started.
Let's get some money.
From New Money, New Problems, it's the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen. Negotiating compensation, purchasing your first investment property, helping your family with money, the highs and lows of entrepreneurship. New money brings new problems that require new solutions. Join us as we work through them together. I'm Brenton Harrison, and this is the New Money, New Problems podcast.
Hello, my name is Brenton Harrison of New Money, New Problems, and your host for the New Money, New Problems podcast. I hope that you are enjoying your week after Memorial Day and that you got to have some good barbecue somewhere on this past Monday. In this week's episode, we are going to share some tips and tricks and things that I don't think are good tips and tricks as it relates to home buying. And the reason that we're doing this is we actually have a webinar upcoming that is going to focus on some home buying strategies that I do think are good strategies, specifically for high income earners who are trying to buy a home or will be trying in the near future. That said, in today's episode, we're going to be focusing on some things that I've seen people, in my opinion, do wrong when it comes to shopping for home loans. And I'm going to share 5 quick strategies that I've seen enacted that I happen to disagree with. And I'm hopefully going to give you some alternatives that you can use instead. And the first strategy is putting 20% down on your home just to avoid PMI. We've actually done an episode on this in the past, and we'll put a link to that episode in the show notes. But PMI stands for private mortgage insurance, and it's insurance that your lender puts on your home loan to protect them in the event that you default on that property. And it's something that people kind of see as like the big boogeyman that you have to avoid. And the way that you typically avoid it is you would put at least 20% down on your new home loan. So for example, if you have a home that's $100,000, you would need to put at least 80% down. That would be $80,000. And if not, you would have this little amount, little in some cases, larger in other cases, tacked onto your home payment, where instead of saying, hey, I'm paying $1,000 a month, maybe you're paying $1,100 a month. And that extra $100 provides some protection to your lender, but it does not do anything for your finances. So people see it like you're throwing money away. And I can definitely understand that perspective. But while I can understand that perspective, it is not a rule of thumb that I think should be followed in all circumstances. And the reason for it is I think that there's a radical misunderstanding of not just what PMI will actually cost you, but also the available alternatives. So first, let's talk about what it will cost you. If you're looking on screen, we're looking at an article from NerdWallet that actually has a calculator for average private mortgage insurance premiums based on different credit scores. And this is one of the misconceptions about cost. The amount that you pay for PMI is dictated by the credit score that you bring to the table. So if you have a better credit score on the same home loan, you'll pay less in PMI than someone who went and bought that property and had a lower credit score. As an example, let's say that we have someone who has a $400,000 home loan, but they have low credit. Their credit score is between 620 and 639. Well, you can see on this page that the average annual premium for someone in that credit score is 1.5% of the loan amount, which in this case is $400,000. That means that somebody who falls in this range would have a monthly payment of $500 a month in private mortgage insurance. And that is significant, especially because the higher income you earn, it's not like you can take a tax deduction for that PMI. So it really can be seen as $500 a month that's being flushed down the drain. However, let's take that same home loan of $400,000 and let's assume that this person has stellar credit. They have a credit score of 760 or above. And that means that instead of paying 1.5% in PMI cost, they're paying 0.46% based on the value of the loan. Well, instead of $500 a month, that knocks their payment down to $153.33 based on these averages. Now, to be clear, is $153 a month that you're not financially benefiting from something that you should just pursue? No, of course, it's not something that you would want, but now we start to talk about the available alternatives. Now, if their mortgage is $400,000 and they had a 10% down payment, that would mean that their actual home purchase was about $445,000. That's how the math works out. So at $445,000, they chose to make a down payment that got them down to that $400,000 mortgage. And they have PMI and they put 10% down to do so, which was about $40,000. Now, because it's not 20%, that means that they have to pay $153 a month in PMI until they reach that threshold. However, the alternative would have been to put 20% down on that property. And that additional amount to meet that threshold and avoid PMI would mean another $45,000 that they had to put as that down payment. Now, to be clear, if you have money just in droves and $45,000 isn't a big deal to you, then that may be worth doing. But if you have excellent credit and you are trying to figure out, should I give them $45,000 or should I pay $150 a month? I would say that you should at least consider keeping that $45,000 and either having it for a reserve and a rainy day fund, or even putting a portion of it in the market so that you have the opportunity to earn an interest rate far and above what it could be costing you on that mortgage. Now, there are no guarantees in that scenario, but the point is just choosing to give someone an extra $45,000 is a bigger decision than people give it credit for. And if you have strong credit and you're doing it to avoid $150 a month, it's something that you should think through a little more thoroughly, in my opinion. I would also add, and this is something that we are definitely going to talk about in the webinar, not all loans require you to put 20% down in order to avoid PMI. If you have a high income, it often makes you eligible for special loan products not eligible to others. And it is very reasonable to find a product that allows you to do a 10% down payment with no PMI. And even if you did find yourself in a position where there was no special loan product and you did have the 20% down, but you chose to put the 10% because you're listening to Brenton, and 5 years into the process, you find out, you know what, I'm going to be here for a very long period of time. I really wish I didn't have this PMI on this home loan. I don't like the strategy that Brenton told me. You could also have the opportunity of what's called recasting your loan. Not to make this whole episode a teaser, but we'll talk about recasting your loan on the webinar as well. But the premise of it is this: if you have a loan that's $400,000, and it's a 30-year home loan, they're going to do an amortization, basically a calculation of what's needed to make a payment every month for those 360 months. And at the end of that process, owe $0. Now, let's say that 2-3 years into the process, you decide to make a large lump sum payment towards your mortgage. Well, now, if you look at that amortization table, you owe less than what they were expecting you to owe at that point in time. So you can ask them to recast your mortgage, meaning that they would recalculate what's needed on a monthly basis in order to have your loan balance be at zero at the end of the 30 years. So if you do feel differently and you do 5 or 6 years into the property know that you're going to be there long term, you could make the down payment then, ask them to recast the mortgage, and still get the savings that you were considering at the beginning of the process. The next strategy that I don't approve of is only applying with one lender. And I see this all the time. And I will tell you, my philosophy is I don't care if my mother is the one representing the lender that I'm applying with. I always apply with at least 3 lenders. As a matter of fact, I want to say with our last property purchase, when we got into this home, that we applied with like 6 or 7 different lenders. And I did it in rapid succession. So we'll talk about that shortly. But the reason that I always encourage people to apply with at least 3 is because loan terms can vary greatly with different lenders. It's different when you're applying for something like a first-time home purchase where that's a federally backed mortgage, and there are some guidelines that make it a little more boilerplate when it comes to going from one lender to the next. But when you're not applying for those type of programs, especially when it's a higher property in terms of value, there are products that don't have the same terms. There are lenders that don't have the same regulations, either in terms of what they offer for the loan itself or how they view your finances when you apply for things like debt to income ratio. So you want to make sure that you have a wide swath in terms of things that you can compare, which is why I encourage people to not only go with 3, but to have those 3 be different types of entities, right? So instead of going and getting 3 regional lenders or local lenders, you might get 1 local bank, 1 online lender, and 1 broker, right? Try to make sure that there's like a different type of representation from each place that you're getting a quote. And then you can compare and contrast what's out there and have a better feel for the market. Now, when you do this, you want to make sure you do this with some strategy. You can't just say, oh, I'm looking for a home at some point in 2025. So in January, I had them pull my credit. And then I didn't really want to buy anything at that time. So in June, I had them check my credit again. This is the type of strategy that you deploy when you are about to buy a home. And the way that you do it is what I call the 14-day rule. So there are different types of credit scores, and there are two different silos in which those scores fall. There's FICO scores, and then there's Vantage scores. Most home lenders are going to go off of FICO, but even within that FICO silo, there are different versions of the FICO score. And depending on that version, it's going to have different rules in terms of how it treats credit inquiries. And a credit inquiry is something that is a small part of what makes up your credit score. It's only 10%. But when you have a bunch of them in short order, it can actually do some damage in a short period of time, right? You can't just have 4 different credit inquiries in 1 year without seeing an impact and a nosedive on your credit score. If you look at the different versions of FICO, you'll find that anywhere from 14 to 45 days is the window that they give you to have multiple credit inquiries for the same type of application without it showing up as more than one credit inquiry. So for example, if I'm shopping for a car loan and I am following the 14-day rule and I go get 5 different credit pulls from different auto lenders within a 14-day period, even though I had 5 different credit pulls, because it was for the same type of application, it will only have the impact of one inquiry when I look at the impact of my credit score. Now, because different versions may take it out as long as 45 days, to be safe, I say go with the 14-day rule. Get all of your finances in order that you would need to get pre-approved for the property. Set your timer in your calendar for when you're going to do the first application. And when you're watching TV at night, just crank out another 1 or 2 or 3 or 4 or 5 or 6 in my case, so that you can get a feel for multiple different lenders without having a negative impact on your credit. But the one thing I would encourage you not to do is to apply with one and go about your day. Now, the next mistake is the actual opposite end of that strategy, and it's having people doing the shopping for you. We're not going to go into the names of specific companies because I don't want to put myself at risk of a lawsuit, but there is a model out there where people understand and companies understand that you want to get quotes from various carriers, but instead of you being in charge of actually going out and getting the quotes from those various entities, they will do it for you. So they have like a centralized place where you will go and input your information. And once you input your information, they will send it out to 10, 15 different carriers to get quotes on your behalf. Now, here's the problem with this. If you're not very careful, if you don't understand the rules that are associated with that centralized location, not only are you asking for different quotes, you are giving permission for each entity on that platform to reach out and vie for your services and vie for that loan. And this is a mistake that I made firsthand, right? I have personally felt the consequences of these mistakes because I put my information on these platforms and been hounded 3 and 4 times a day from different companies for over a month because they saw my inquiry come in on the platform and they're reaching out to me with the information that I put in, including my cell phone, asking every day if I'm ready to be pre-approved, asking every day if I can send my tax return in to complete the process. And it wasn't something that I was ready to do. So if you find one of these platforms and it says, hey, we offer mortgage quotes from 10 or 15 different lenders, beware that it's not just you getting the quote. It's also putting your name on a list to be contacted by potentially all of those lenders.
This is the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen. We'll be right back.
Are you wondering what new money problems you might be overlooking in your financial life? If so, we've got great news. We've crafted the New Money, New Problems Gap Finder to identify potential weaknesses in your finances in areas ranging from budgeting, investments, insurance, and even the threat your extended family's finances could pose to your household. Please head to newmoneynewproblems.com/gapfinder to complete it today. Again, that's newmoneynewproblems.com/gapfinder to take the assessment.
You're listening to the New Money, New Problems podcast. Subscribe now at newmoneynewproblems.com. Welcome back.
All right, welcome back. Let's get into number 4. And number 4 is you have figured out which lender you're going with. You are now at the application stage and the picking of loans stage, and you are financing with must-haves in mind. Let me break down what that means. I have shared that I don't think there is ever a bad time to buy a home, but I've also shared that it's always a bad time to buy a home that you can't afford. And when I say it's a bad time to buy a home that you can't afford, I have to make sure that you understand you have to be able to afford the loan all the way through. And it can't be a situation where you're like pigeonholing these 10 or 11 perfect scenarios that have to be in place in order for you to not be in trouble financially. Oh, as long as my income stays at this level and I get my bonus every year. Oh, as long as my student loan doesn't go up. That's what I mean by not really being in a position to afford the home. You're only in a position to afford it if everything goes right. And that actually can go farther out than just your budget and into the category of the type of loan that you choose. So for example, we've done an episode on this podcast about adjustable rate mortgages, where you get a mortgage that has a lower interest rate and it's a fixed rate for a set period of time. And I'll have people who will get into this type of loan and they can afford the property as long as it's during the fixed rate period, but they don't have a strategy for what's going to occur if that rate increases after the fixed period ends. And to be clear, one strategy that people will hope for is, hey, during that fixed rate period, maybe interest rates for mortgages in general will come down and I can just refinance. I'm all for that strategy as long as you have prepared for the worst case scenario, which is what if they don't come down? If they don't come down and that fixed rate period ends, are we going to be able to afford the rate with which we're left? If that's the case, go for that strategy. Get the fixed rate and hope that the rates will go down and you can refinance before it ends. And even if it doesn't, you're not in a terrible scenario because you've planned for the alternative. But if you're getting into that loan and you know you can't afford the rate after the fixed rate period ends, then now you're saying that rates have to go down during that period. And that's not a scenario in which I would want you. You also see this with another type of strategy, which we'll talk about on the webinar, which is a 3-2-1 buy down. And the way that a 3-2-1 buy down works is actually pretty simple once you think it through. Essentially what happens is you have a 3-year period where you're paying less than the actual fixed rate on the loan. In year 1, you're paying 3% less than the fixed rate. So if you have a 7% rate, in year 1, you're paying 4%. In year 2, you're paying 2% less than the fixed rate. So if it's a 7% rate, in year 2, you're paying 5%. In year 3, you guessed it, you're paying 1% less than the fixed rate. For 7% rate, you're paying 6% in year 3. And after the 3rd year, you move forward with the rate of 7%. Now, I actually like these products if you can afford the rate at the end of the period because it gives you, number one, an idea of exactly what your rate will be at the end of the period as compared to an adjustable rate mortgage where it's going to be whatever rates are at that time. It also gives you a defined 3-year period where if rates happen to go down, you have the opportunity to refinance within that period, just like with an ARM loan, but in my opinion, with just a little more clarity. So to be clear, I like 3-2-1 buy downs as long as you can afford the rate at the end of the period if you're not able to refinance. But if you're doing it and you're getting into the home and you can only afford it when it's in year 1 and it's at that 3% less than the current rate, that's not the type of scenario that we're looking for. And it's a home buying strategy that I would avoid. And lastly, letting emotions get in the way of how you finance your home. Now, I will tell you, I have seen this a lot, and I don't think it's just emotion. I think sometimes people just don't understand how the loan process works. But to get you to understand this, I want to break down the difference between debt to income ratio and credit score and how it impacts the loan process. And we'll start with debt to income ratio. Debt to income ratio is an assessment of how much of your monthly income is swallowed up by debt payments. And they do debt to income ratio calculations to figure out how much home you can afford, right? If you are trying to get a $500,000 home loan, but your debt to income ratio is too high, they're going to possibly only give you $450,000. So your options are to reduce your monthly debt payments or increase your income. But debt to income ratio determines how much home loan you are offered. Credit score determines the interest rate on that loan. So it doesn't have any impact on whether you get $450,000 or $500,000. It has an impact on whether the rate that you get is going to be 7% or 6.5%. How does this factor into emotions? I come across a lot of couples where there's a huge imbalance when it comes to the income that they bring to the table. And to be clear, I come across several couples where this is not an issue at all, but I come across situations where there is a clear dynamic at play where the imbalance of incomes is something that impacts the relationship if it gets away from the couple, which is, natural to some degree. The problem, however, occurs when you take that and you try to make it balanced in terms of how you finance the property. So for example, putting a person on a home loan that doesn't have to be on the home loan to make them feel better about that dynamic. So if I have a person whose income is high enough where the debt to income ratio allows them to get as much home as they want without including their partner's income, well, really, if their credit score is high enough, the partner is someone who's now on the loan to be on the loan, but they don't necessarily have to be on the loan. And if the lower income spouse has stellar credit, this is not a problem at all. But it is a major problem if the person who's the lower income earning spouse has poor credit or a lower rung of credit than the higher income earning spouse, and now we're putting them on the loan. Why is it a problem? Because many loan products will use the credit score to determine your interest rate, and the credit score that they use is not an average of the two scores, it's the lower of the two scores. So if you're applying for a loan and the best credit that they have in terms of the rung that gives you the best interest rate is say 759 or 760 and above, and the high income earning spouse has that credit score and could apply for that home loan on their own, and you bring a person onto the home loan that has a 720 credit score, which is still an excellent credit score, but it's not in the highest rung, you are now potentially putting yourself in a scenario where you have a higher home loan rate than you would have if you just left the person off. And to be clear, I understand this. Finances are emotional. It's tough to get on the same accord with your spouse and your partner when it comes to how you deal with money and making sure you know and they know that you love each other regardless of what each of you bring to the table financially, right? It's not all about that. But there are other ways to express that it's all about that than putting someone on a home loan that damages the loan itself. I would also say that to me, if I were in a situation where I could be on the deed of a property, meaning that I'm the owner of the property without being on the loan of that property, that's not too bad of a deal. I don't think people think of it that way. You can easily have your partner, your spouse on the deed of your home, which means that they have the same ownership rights that you do. They're just not carrying the debt on that property in the way that you are. So even though this is something where I'm not trying to start an argument with your spouse, it does have to be brought up. And I'd rather you have a tough conversation and say, look, your name will be on the deed, but we are costing ourselves potentially tens of thousands of dollars over 30 years by putting you on this loan. That's a conversation that's worth having, no matter how awkward it may be. So those are the 5 home loan strategies that I disapprove of. I hope that at least one of them resonated with you or gave you some information that you weren't aware of prior to this episode. Once again, we have a webinar coming up for high income earners and how they buy a home on Tuesday, June 17th. You can click the link in the show notes to register. Hope you show up. Hope you bring a friend. And I will see you again for next week's episode.
Let's get some money.
From New Money, New Problems, this was the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen.